Fund Supermart, your online gateway to unit trusts.
Hi Trent, thank you for being here with us today. The First State Global Infrastructure Fund has had a strong track record since its inception. So to start off, could you tell us some of the reasons why investors should consider an allocation into listed infrastructure?
There's really three reasons today that we're seeing that clients are investing in listed infrastructure. One, it's the income that it provides. If you look at the last 20 years, infrastructure has provided investors with a very reliable income of around 4% per annum. The second reason is growth, and it's what we call structural growth. So this is growth that in many ways is less dependent on the economic cycle. So for example, mobile towers, toll roads, these are all benefiting from structural growth stories such as urbanisation, the movement of people into cities, and the increased use of iPhones, iPads is driving the need for more and more data to be used, which is benefiting the communications infrastructure companies. And the third reason is really the lower volatility. We're seeing more and more clients use listed infrastructure as a defensive equity in their portfolio because of the lower volatility and the less correlation that it has to general equities.
Could you tell us more about your research process and your approach to stock selection for the fund's portfolio?
So we have an investment team of 8 dedicated people who have come from an infrastructure background. We've built a team of specialists to look at this asset class. From a universe of 300 companies around the world, listed infrastructure companies, we screen that down to around 120, and then we build a portfolio from the bottom up of around 40 securities or 40 companies. There's a real focus on identifying quality infrastructure assets, but also looking for mispricing. We are investing in listed markets. Sometimes that creates mispricing opportunities, and it's our job as active managers to identify those. So we're looking for companies with high barriers to entry, good pricing power, and the ability to continue to be able to grow their earnings and pay out a good steady income for our clients.
How has the global infrastructure sector performed this year, and has it been affected by the plunge in oil and commodity prices?
Well, the last year has seen a lot of, increased volatility in markets. You've seen, particularly in emerging markets in the last 6 months, you've seen increased volatility there. And infrastructure as an asset class has also seen some of that volatility. But that's actually, as active managers, created opportunities for us. We've tended to be more cautious. Some of the income sectors that have been chased for their yield, such as regulated utilities. We've been cautious energy pipelines for some time. But what you've seen now with the correction in the oil price falling from $110 12 months ago to essentially half that today, that's now started to create, that's led to some volatility in markets, but that's also created some opportunities for us. We're now investing again in the energy pipeline space, but it's also benefited some of the toll road companies, the airports. But just again as a reminder, we're investing in very stable, defensive businesses here with very minimal, if any, commodity risk and very little volume risk. So the earnings for the asset class have continued to be quite steady throughout this period, despite the volatility that you've seen in markets.
So how has the fund performed this year, and which allocations across different countries and sectors have contributed the most to your returns over the course of this year?
So our fund has outperformed the benchmark, which has been important for our clients. It's also outperformed global equities. You've seen volatility in global equity markets. That's created it has led to a bit of a pullback after a few years of very strong performance. But that's created mispricing opportunities for us. It's meant that we've been investing much more in the growth infrastructure companies like freight rail, like toll roads, or like ports, and more so away from the regulated utilities these are assets that will perhaps be more sensitive to interest rates going up, and where valuations, in our view, have got ahead of themselves.
So where do you see investment opportunities? And are there any sectors within infrastructure that you are bullish or bearish on, and why?
So we're generally, we tend to favour firstly developed market infrastructure companies. The number one risk when investing in infrastructure for us is the regulatory, the political and the legal risk. And those risks are historically higher in emerging markets. So firstly, we're favouring the more developed market countries. Given the pullback you've seen in valuations in emerging markets, we have been starting to see some opportunities there. But in terms of allocations, as I said earlier, I guess it's really favouring more the growth infrastructure companies, the companies where we're seeing really a good structural growth, growth in the demand, so communications, mobile towers, toll roads, ports. These are the companies that we've really been favouring. And being more cautious, the regulated utilities, airports today. We like airports as an infrastructure asset, but in our view, valuations have started to look too full in that space.
So what is your outlook for the global infrastructure sector over the next 2 to 3 years?
Well, the outlook for infrastructure and listed infrastructure is positive. We're long-term believers in this asset class. They'll continue to pay a reliable dividend yield of around 4% per annum. We're forecasting 5 to 7% earnings growth for the companies that we invest in. The balance sheets are generally in very good shape for these companies. And the growth prospects that I've identified continue to be strong. The number one risk remains to be the political and the legal and regulatory risk. That's not just in emerging markets, but also in some developed countries now too. So we continue to remind investors of the importance of focusing on that. And finally, this is a universe that continues to expand. We're seeing more and more companies, more and more governments sell their assets. We're seeing companies selling non-core assets, which is creating more opportunities for us to invest. So we believe the universe will only continue to expand in the future.
Thank you very much for your insights.
Thank you very much.